Real estate investment presentation, underwriting. Get ready because we're raising the stakes with real estate. As we define underwriting, think about how it fits into your overall real estate investment strategy. We're referencing Investopedia, Troy Seagal. Investopedia, a place you can go to look up investment-related terminology, continuing your research from there. Underwriting refers to the process lenders use to determine the creditworthiness of a potential customer. It's a very important part of the financial business because it helps determine how much of a premium someone will pay for their insurance, how fair borrowing rates are set, and also sets prices for investment risk. So how is the underwriting process going to work? Along with looking at the truthfulness of an individual's application, so clearly within the underwriting process, they're going to look at the application, the information related to it, and see whether or not it is truthful. The underwriter will also research how risky it will be to lend to or insure that person before doing business with that individual or company. Looking at the information, then they're going to use that information in order to determine the risk that will be involved. Clearly that risk assessment then will be used to set the terms and so on as the business process then goes forward. So in essence, the underwriting is fact-checking due diligence on the insurer and lender's part before assuming any risk. So the insurer and the lenders, the bank, of course, making the loans, and the insurers that are being involved, that are going to have risk involved, that are taking on risk within their business transactions with the home purchaser, is going to want to have the due diligence done, and this is the process for that. The role of underwriters. The underwriter conducts research to ensure applicants represent themselves truthfully and to get a sense of the applicant's finances. So they want to be saying, can we trust this person we're doing business with here? And two, what do their finances look like? What are going to be the risks revolving or involved with them? For real estate transactions, underwriters also determine whether the property's sales price meets the appraised value. So you got that process with the appraised value. You might have the appraisal kind of process. We talked about different ideas or ways we could look at the appraisal process. We can think about it as a process that needs to be going through to help with the assurance side with regards to the lenders who are then going to be giving out a loan and using the property as collateral to make sure that the property is at least over and above then the amount of the loan. We can also think of the appraisal, and that will lower the risk then to the lender. We can also just think of the appraisal process as basically the appraising, the valuing of the property. So in other words, you might appraise the property to determine the value of the property, to get an idea of what you would set the sales price for or purchase for. And then you have the concept of a third-party appraisal, independent appraisal of the property that hopefully can be relied upon by the two people or multiple people in a sales transactions. The role of the underwriters continued. The underwriter is responsible to determine the potential borrower's creditworthiness and assign them a rating. So they're going to go through that whole process of checking the credit and so on to give you a rating with regards to your creditworthiness. That then is going to be dependent upon when you go through the transactions and complete your agreements through the process of the purchasing and selling process. This rating determined by the credit score provided by the three major credit bureaus. So you get the three major credit bureaus. We've talked about that, I believe, in prior presentations. We might go into it a little bit more in depth in future presentations, how they go through that credit checking process. But you're going to check the credit ratings, represents the applicant's ability to repay the loan, the amount of funds they have in reserve, and their employment history. So underwriting and real estate. When an individual or business entity seeks funding for a real estate project or purchase, the loan request is scrutinized by an underwriter to determine how much risk the lender is willing to accept. So clearly the underwriting process is there for the lender side to help them determine the risk that is there and therefore set the terms, in essence, with regards to the relevant risk that is there. So these types of underwriters are not to be confused with securities underwriters who determine the offer price of financial instruments. Real estate underwriters take into consideration both the land and the borrower. Borrowers are required to have an appraisal conducted on the property. The underwriter orders the appraisal and uses it to determine if the funds from the sale of the property are enough to cover the amount lent. So clearly, that's that appraisal process. The lender is going to want the assurance that if they're going to be loaning money, that the value of the property is equal or hopefully above the value of the loan. In the event that the borrower does not repay, they have then the recourse and can recover the value of the loan due to the fact that the value of property is higher than the value of the loan. So for example, if a borrower wants to purchase a home for $300,000 that an appraisal deems to be worth $200,000, the underwriter is unlikely to approve the loan, or at least a loan for the full $300,000. So if you're saying, hey, I want $300,000 to help me go through this real estate transaction where the property that I'm using as collateral is only $200,000, then the bank's going to say, well, no, we're not going to give you $300,000 because the assurance on it is only at the $200,000, so that's generally not going to work. So underwriting and real estate underwriters also make sure other factors with the property are in check. This includes ensuring there's no one else on the title. So this is going to go through the title process, meaning the claim, in essence, to the ownership of the property, which can get kind of complex in certain circumstances depending on the real estate being purchased and whether there are any dangers to the property due to natural disasters such as floods or earthquakes. So they're looking at the risk involved there. Is there risk in the event of someone else basically trying to claim title or ownership of the property? And are there substantial risks with relation to natural disasters that are over and above the normal risks that are involved as well? In most real estate loans, the property itself is used as collateral against the borrowed funds. So clearly that's going to generally be the transaction. The borrowed funds are borrowed with the expectation and of the home being collateral so that if the loan is not repaid, they can go after then the property. Underwriters generally use the debt service coverage ratio, DSCR, to determine if the property is able to redeem its own value. We might take a little bit more in-depth look at that, but there is that. If so, the loan is more secure proposition and the loan request has a greater chance of being accepted. So remember, we're referencing Investopedia, What is Real Estate Underwriting by Troy Siegel, updated August 18, 2021. You could take a look there and continue your research at that point. They do update their information, so as time passes, you might want to think about looking there for references and see if any updates have taken place to continue on your research.